Good afternoon, students. Welcome to our business studies lesson. Our topic today is determining the net worth of a business. And our subtopic, which is our lesson today, is terms used in business. Our lesson objectives are, by the end of the lesson, the learner should be able to define the basic terms used in business. Normally, in a business, there are so many business activities, and these business activities involve the exchange of goods and services. These goods and services are bought on cash or on credit, and the exchange is between the sellers and the buyers. These business activities lead us to what we call business transactions. A business transaction is a dealing between two or more parties that can be assigned monetary value. Now, these many business transactions require to be recorded in a good manner. And this leads us what we call bookkeeping and accounting. Bookkeeping is a branch of a wider subject or a unit called accounting. Bookkeeping is defined as a systematic way of recording business transactions in monetary terms in a set of records. And accounting is the systematic recording of transactions, analysis of the records, and interpretation for decision making. Today we shall require to define some terms used in business. That is the basic terms. Term number one is a debtor. A debtor is an organization that owes money to another organization, or a person that owes money to another person. In our case, we shall use two people. That is Atieno and a Mwamburi. If Atieno buys goods on credit from Mwamburi, then Atieno is a debtor, since he has bought goods on credit from Mwamburi. Term number two, creditor. Creditor is a person who is owed money by another organization. So in our previous case, Atieno bought from Mwamburi on credit. So Atieno is supposed to pay Mwamburi. That means since he bought from Mwamburi on credit, then Mwamburi is the creditor. 3, that's goods or stock. These are items bought with the aim of reselling. For instance, a kiosk owner might buy some groceries with the intention of selling the groceries. The groceries are the stock. 4, we have the assets. Assets are items of value owned by a business. We have two types of assets: fixed assets and current assets. The fixed assets are items of value owned by a business and expected to last for a long period in the business, normally a period of more than 1 year. For example, land that's owned by the business, or buildings owned by the business, vehicles owned by the business, or even the furniture and the fittings of the building. We have type number 2, current assets. They are assets expected to last for a short period in the business, normally less than 1 year. For example, stock of goods that are meant to be bought and resold within a short duration. Cash in hand, cash at bank, and even prepaid bills. The characteristics of assets are: 1. Resource owned and controlled by the business. They are items of value measured in monetary terms. 3. They must have been acquired in the past. 4. They are classified into two, that is, fixed assets and current assets. 5. Any future economic benefit associated with the net expected benefit is to be received by the business entity. 4. The liabilities. They are items of value owed by business to other businesses. For example, a loan from a friend or a bank, stock that is bought on credit, and accrued bills. There are two types of liabilities. We have long-term liabilities and short-term liabilities. The short-term liabilities are also called the current liabilities. The long-term liabilities are expected to be payable within a period, are not expected to be paid within a period of 1 year. For example, a 5-year loan bank. Then the current liabilities, these ones are expected to be settled within 1 year. For example, the creditors, the bank overdraft, and accrued expenses. The characteristics of the liabilities are: 1. It's a present obligation for business to settle as a result of past commitment. E-settlement may reduce business assets. For instance, if you settle creditors using cash, then cash will be reduced. The amount involved is valued in monetary terms. 4. Owned by outsiders. 5. They are either short-term or long-term liabilities. Another term, which is the last one, is capital. Capital is the initial money that one invests in a business. Second definition of capital. Capital is the owner's claims or owner's equity in the business. That is what the owner can claim to be his. The third definition of capital is: capital is the excess of assets over liabilities. That means capital is equal to assets minus liabilities. So the excess is called capital. With this is the last definition is what will lead us to our next lesson, that is the bookkeeping question. Thank you.